Hello out there, everybody. Today we're going to talk a little bit about the required financial statements that we learn in Principles of Accounting. If you're about halfway through your first term in Principles of Accounting, you should have learned 2 financial statements already. So I want to review those real quick, and then that will lead us into the third required financial statement that we're really here to talk about today, which is called the Statement of Cash Flows. So we'll start off. Let's look at Nike Incorporated. You all know about Nike, the big apparel maker. You probably have a pair of Nike shoes somewhere in your closet. You may even have a pair on right now. But we'll look at their income statement here, and if you recall from your Principles of Accounting class, hopefully you've already learned that the income statement is going to tell us how much money we made. It's kind of the accountant's way of keeping score for the year or the month or whatever accounting period we're talking about. In the case of Nike, the statement we're looking at right here, we're talking about a year, so the income statement is going to tell us what amount of money that Nike made during the year. And the way we come up with that number is we simply start with our revenue. When we back out our expenses, revenue minus our expenses is going to give us a number called net income. And like we said, we kind of consider that to be the amount of money that we made. So I'm going to jot down the number that Nike has on their financial statement there. It looks like they had $2.693 billion of net income in 2014. So let's jot that down. We'll kind of ignore 2013 right now. We'll just get that 2014 number. 2.693 billion. What that means is that is the amount of money that Nike stuck in their pocket as profit after they had paid off all the bills and all the expenses they had during the year. They had a pretty good little profit there. The other financial statement that you should be aware of at this point in time is called the balance sheet. Here we see Nike's balance sheet, and if you recall, the balance sheet is simply going to tell us what we own, those are our assets, what we owe, our liabilities, and then what the difference is, how much equity or ownership do the owners have in the company. So basically, what we have, what we own in the company, and who has a claim to it. Is it a creditor claim or is it our claim? And that's the balance sheet. If we take a look at Nike, I want to kind of focus on the top line here. You see Nike had cash of $2.20 billion in 2014, and that was a drop from 2013 of $3.3 billion. So let's jot those numbers down. Get this out of the way so we can see what we're writing down here. Okay. Cash in 2014, $2.2 billion. In 2013, $3.3 billion. Now, let's stop right there for a second. As we looked at the income statement, we said we had a profit of $2.6 billion. But if we look at our cash balance, our cash actually went down from $3 billion to $2 billion. It went down about $1.1 billion over the course of that year. So you look at that, and that doesn't really make a whole lot of sense. If you think if you have net income, we consider income to be how much money we made, but then we look at our cash balance, and our cash balance goes down. So how can we be making money, yet our cash is still going down? There's kind of a missing piece of the puzzle right here, and that's kind of where our third statement comes in. Our third statement is called the cash flow statement. And all that statement is going to tell us is how we get from our beginning cash to our ending amount. It's a pretty involved statement. Let me bring it up here and show it to you. Here it is right here. Here's Nike's consolidated statement of cash flows. And as you can see, if we go all the way to the bottom, cash and equivalents at the beginning of the year, there's the number you saw on the balance sheet. If we back out how much cash went up or down, we end up with cash and equivalents at the end of the year. So basically, this whole statement is going to tell us what we began with in our cash account, how much our cash went up or down, and then what we ended up with at the end of the year. So if you want to think of a cash flow statement as a glorified checking account register, that's kind of what we're looking at. There's 3 areas to a cash flow statement, and we'll learn more about these as we go along, but just to give you an overview, our cash flow statement is always going to be broken down into 3 areas. we'll have our cash provided by operations. And basically what that is, it's going to be the amount of cash that we generated from running the business. So in the case of Nike, that would be the amount of cash that we generated from making apparel, making shoes, and then selling them to the public. As you can see, Nike generated $3 billion in cash just from their operations alone. The other two categories are going to involve investing activities and financing activities. A company's investing activities involve buying long-term assets like property, equipment, machinery, that kind of thing, and long-term investments. We can see here that Nike had a cash outflow of $1.2 billion during 2014. So since it was a cash outflow, they spent more dollars out than came in for their investing activities. We say it was a cash used by investing activities. As you can see, a lot of that came from them buying short-term investments. The final category in our cash flow statement is called cash used up or provided by financing activities. Essentially what is going to happen in that part, a financing activity is anything that has to do with our dealings with creditors or with the owners of the company. So that could include borrowing money, paying back money. It could include issuing a dividend, selling stock, or buying back stock. As we can see here, Nike had a cash outflow of nearly $3 billion in financing activities, and the majority of that came from Nike buying back their own stock and paying dividends. So you take all those three activities together, lump them up, and you find out that we had an overall decrease in cash of $1 billion. It took us from $3 billion at the beginning of the year in cash to $2 billion. That's essentially what's going on in a cash flow statement. That's an overview. In other videos, we'll talk about how to actually put that statement together.